Hello and welcome to a brand new show of Market Makers. My guest on the show today is Rashesh Shah, Field Vice. Rashesh, good to have you back on the show. Thank you for joining us.
Happy to be here.
I guess the green tie is really symbolizing the market mood. A week ago, or a month ago, I would say it was all about fear. Now there is hope and excitement.
Yeah, actually, I think if you remember, for the last about 5-6 months, we have always strongly maintained that calendar 2012, there have been significant improvements on a lot of parameters, current account gap, inflation has come down, RBI cut rates in April, all of that. So there was gradual slight improvement happening in the Indian situation and the global situation. So given that, I think there was, I wouldn't call it optimism, but there was a very clear, I think, reduction of, pessimism and fear until then. And I think in the last 4 weeks, obviously, I think coupled with the global liquidity as well as, a lot of action on the Indian front, I think optimism has started to come back.
But is this as good as it gets?
No, I think it's a start of that. I think ultimately on a long-term basis, as good as it gets is when India gets to, say, about 8% growth. When inflation is somewhere in the 5 to 6% range, that would be for me as good as it gets. I think a 8% growth with a 5% inflation would be very good. I mean, I'm not one of those who is hoping for 11-12% growth because I think there are structural issues India may have to address before we get there, if we ever get there. I hope sometimes, but I think 8% is achievable for us. So if we get to 8%, bring inflation down, all of that, that would be as good as it gets for the India story.
Rashesh, whereas we are trumpeting and we are cheering all the reforms which have come from center, but FDI in aviation or FDI in retail, these are not game-changing reforms. They will not add to my GDP and they will not fix my macro. So what are markets exactly celebrating?
It's, I think there are 3-4 things always at play in this. You call them reforms, you call them clear policy action that the government is willing to stand up to, to allies who are against it and still, out of conviction got the action done. It's also like if you are starving and even if you get a little bit of food, it's not a feast, but I mean that food is very sweet. So I think the India story was starved of, any policy action, any clarity on direction, whether really we are committed to growth or not. We are committed to clean up, a lot of things like this subsidies and all of that. So I think it is more the signaling effect which has created a big psychological impact that, okay, you cannot, because everybody believed that we cannot write off India on a long-term basis. However, the short-term stagnation and the short-term, paralysis and not going anywhere was starting to, I think affect everybody, investors and all. So this entire policy action has shown that given that the long-term story has always been good, there is action also happening now. So I think it is the combination of that which is giving people a little bit of optimism. But as I said, I think increasingly each action by itself may be a very small thing, and you can ask that if it was so small, why did it take so long? But I think the combination of that is clearly indicating that the government is committed to action. The government is, and even the statements by the government and the Prime Minister is started meeting industry people and again showing that they are cognizant of the growth crisis that we had and they are committed to growth.
So Indian markets are up 25% in this calendar year. Nifty is up about 9% already in the month of September. How much more do you think the rally could last, and how exactly should long-term investors now position their portfolio?
See, overall, the market is still fairly valued because I think earnings growth is also coming back because the corporate balance sheets are strong and all, and the global liquidity because we are in a risk-on situation also. So I think overall, it has been the whole year, according to us, has been a good time to invest slowly. And I think ultimately, if you want to, I think the trading time is over. Maybe the investing time starts now. So I don't think after such a big, rally and big jump and all, there are a lot of trading opportunities left. But I think investing wise, if you look at the next 3-4 years, and if you think that now RBI policy action in terms of cutting rates is on the cards, they already cut the CRR rate, maybe the interest rate cut is on the cards. If all that happens, I think fortunately in spite of, the global liquidity and QE3 in the last 4 weeks, oil prices come down. India's, oil basket in rupee terms is down 8-9%. all this will help inflation, all this will help RBI's ability to cut rates. And I think given that all the stuff that is going on with the government, and if RBI also cuts rates and the liquidity situation is improving, there could be good stuff that will happen from a growth point of view. So I think investing could be a good time for starting to look at investment opportunities.
You know, I challenged your optimism last time, but I want to challenge your belief this time. You are constructing a rosy scenario, but is the bullish Rashesh Shah mindful of global headwinds?
See, global headwinds will always be there. I don't think the global headwinds affected us as much as the India stagnation and the policy paralysis and the high inflation and the high interest rates and all of that. So I think if I look at India's problem, there were 5 issues, and we spoke about it last time. Our current account gap, or fiscal deficit, inflation, policy paralysis, and the global scenario. So global scenario is only one out of the 5 issues that were affecting India. But I think on the interest rate now there is optimism. I mean, RBI cut rates in April, but now there is more optimism. I think on the current account gap also things are coming back under control, and we expect the current account gap, which had gone as high as 4.3%, should be around 3% for this year. So I think even on that, and even at 3% with the FII inflows and all, the rupee has been fairly stable. So I think given all of these issues, so on the rupee front, on the current account front, on the inflation front, on the interest rate front, there is optimism. On the policy front, there is optimism, and the global front, there is optimism. So even if the global scenario turns around, the other positives will still remain.
You know, when I was preparing for this interview, I was looking at some numbers, because you're always good at numbers. So the numbers are, foreign institutional investors this year have pumped in about $14 billion. Domestic institutional investors have sold equities worth about $5 billion. So if the global risk on trade becomes risk off, money could move out. And unfortunately for us, sentiment has improved. Outlook has changed, but the participation is not there. So domestic institutional investors are still selling.
I think people are still underweight India. If there is a big global shock, India will always be vulnerable, as will be every market in the world. But given from where we sit now and what we see, the comments of the ECB and the comments of the US Fed and all of that, and the liquidity scenario which is there, and where India is also in a way turned around, that doesn't seem to be a very big possibility. But I mean, we live in a world where suddenly on a Tuesday morning some new news will come and everything will become, but from where we sit now, we don't see that coming.
So July, when we interacted with you on the same forum, you made a case that why investors should buy equities. So for those who followed your advice, markets have gone up. Thank you for that call. Should they sell out now? And for those who ignored your advice, should they buy now?
I think it's a good time to buy, because again, all the bad news is in the price. I think the growth cycle in India has started, it will start improving, not started improving yet, but will start improving. We do think interest rates are coming down in India, maybe not in October, maybe in December, maybe after that, but interest rates are coming down. And India, I think at a 6% growth also, there are enough investment opportunities in India. So I think given that interest rates are trending down, for any investor, given the investment opportunities you have, I think equities is a good risk return opportunity now.
Infrastructure has gone through a process of de-rating. Do you think now the P multiple for infrastructure will expand, and if yes, which end of the spectrum you like within the infrastructure?
Actually, I don't know any specific stories, but I think overall infrastructure looks like an interesting one. Obviously, companies which have good assets, companies which assets are getting executed, where they will go into production. If you have a power plant which is still stuck and will not come up for the next few years, I would still be careful of those. But I think there are a lot of good infrastructure companies which have cleaned up their act, which have sold some assets or are in the process of selling some assets. So I think all of that, I think the banks are again becoming very attractive given the interest rate.
PSU banks?
I think partly PSU bank, depending on bank to bank, because there are some very good quality PSU banks which are also hammered down on NPL concerns. But also I think some of the private sector banks starting to look interesting, because when the interest rate cycle starts turning, it will be good for banks. So I think banks and infrastructure companies are the ones where I think people had gone underweight, which they will now start hopefully going overweight.
You have an NBFC business, so you have the overhang of, or the hang of, how things are moving when it comes to the NPA cycle. Do you think NPA concerns in the system are slightly overhyped?
I think they're slightly overhyped. It will not create a banking crisis for us, but it will definitely create some stress assets are there which need to work its way through the system. And usually in banking there are a couple of ways you do it. Either you take the pain very fast, very quickly, and work its way very fast, which is called the US way, or you work it very slowly and slowly kick the can down the road, which is called the European way. Nobody knows, which is a more optimal way. But on the whole, I think there are stressed assets in India because of a lot of the infrastructure projects and all which got stuck for government clearances and other reasons, for coal and everything else, which still will have to be restructured. So there is still pain in the system. The pain will have to be, absorbed, cleaned up and all. It won't put the system in crisis, but it could affect growth going forward.
Markets have been hiding in private sector banks, and the view is that private banks are better managed, they have a better balance sheet, they have a better control on NPAs. But is it too naive to assume that at a time when the country is going through an economic downturn, private banks will be able to, protect their NPAs?
No, I think everybody will get affected if the NPL cycle is up. A large part of the NPL cycle is in what is called project finance. Like the retail portfolios are very healthy. Most of the private banks have a much higher percentage of the retail portfolio. So I think it is more a combination of business that they don't have as large a component of the project finance business, which is the one that is largely under stress. So given all of that, I don't think they'll be completely immune, but what will happen, Nikunj, for the country to grow at say even 6% of real GDP growth with inflation of another 6%, you're looking at a 12% nominal growth. A 12% nominal growth would say that the credit growth in the system will have to be 18% or 20%. Now, if some of the banks are still cleaning up their NPLs and all that, the ones which can grow faster and use this 18%, 20% credit growth opportunity which is there, it will be great for them.
Every cycle, Rashesh, has given us new winners and new losers. So if I work with the assumption that the new cycle will start in next 12 to 18 months, which sectors, which companies, which businesses do you think will emerge as bigger winners?
I think on the whole, you should not go by only sectors. I think I would go by companies, because I think ultimately it's the quality of the management team, the aspirations of the management team, the quality of the balance sheet, the kind of business model they are operating in. Like I think even now a lot of people believe that there are a lot of good companies across the board which you can invest in. Some are in stressed industries, some are not in stressed industries. The ones in stressed industries are undervalued, the ones in not stressed industries are fairly valued. But I think it is be from company to company, and which is what all the investors do, is go company to company. But they are very good pockets. I think the mid-cap IT has been doing well. On the pharma side, on the mid-cap pharma, there are still a lot of opportunities. There are quite a few good infrastructure companies that will come back. I think some of the PSU banks go company to company, but they are very good pockets. I think the mid-cap IT has been doing well. On the pharma side, on the mid-cap pharma, there are still a lot of opportunities. There are quite a few good infrastructure companies that will come back. I think some of the PSU banks are very strong and have a strong franchise. They'll come back given the current valuation that they have. So I think they'll be, but it won't be as much sector based as I think individual stock specific opportunity that will come about.
Let me use the poker terminology, because that's what you used last time when we interacted. You said it's time to go all in when it comes to equities. Markets are up about 10-12% after we interacted. Is it still time to go all in?
Well, all in is always a function of your risk reward and what kind of opportunity.
In terms of an approach, that just denotes the confidence.
I think it's a good time to be risk on in that sense. Whatever your risk appetite. If you're a 70-year-old retired pensioner, I wouldn't recommend taking risk. But if you're a 40-year-old guy with great career prospects and have enough cash flow to take care of your needs and you can invest money, it is a good time to be in the market. So if you can take risk, it is now turning out to be a good time to be starting to add on risk.
Which asset class do you think would go through a price correction stroke a time correction now?
I think almost, I think if you see real estate will go through some price correction because it is still fairly overvalued as compared to equity and all. I think bonds and all have gone up a lot, and you might see some sideways in that because though interest rates will come down, it is already priced in. So unless interest rates come down very sharply, from 8% GSEC, if you go to 5% GSEC, there will be a lot of opportunity in the fixed income sector. Otherwise, fixed income sector is more going to be sideways, and you have to move, you have to wait for a structural interest rate fall. I think a 40, 50 to 100 basis point cut in interest rates is already priced into the bond prices. So I think that would be a sideways. Equities and commodities, you would be fairly optimistic. Commodities might have a correction because they've gone up a lot. So I think amongst the four asset classes, real estate, commodities, equities, and the fixed income, I would say equities looks the best place to be. But eventually, I think you want to have some things in commodity and some in the fixed income sector also.
Rashesh, what drives the market in the short term and in the medium term, you've always maintained, is sentiment and liquidity. So sentiment has improved, liquidity is strong, but the third moving part is earnings, which is still unpredictable.
Yes, and I think ultimately the real structural, the secular bull run will only happen when you see earnings cycle starting to turn. So
when do you see that coming back?
I think it's still about a year away, and that's why we are telling people to not be in a hurry. And when we say it's a good time to add risk, we are not saying add risk in the next 3 days. I think the next 3 quarters will be a good time to start looking at companies which will come back, because I think a U-turn has happened on, but you have to go, individual opportunity by opportunity. But on the whole, I would feel that the next 3 quarters or 4 quarters will be a good time to increase your risk on equities, start investing in good quality companies. I think quality is going to be the most important part in this. And on the whole, I think earnings cycle is about a year away.
But quality is expensive, isn't it?
No, as I said, I think your ideal bet is a good company, quality company in a bad industry where it will turn around, because that is where the undervaluation is there.
Give me an example of a large cap, because what you're trying to...
As I said, in infrastructure there are some companies in that, in telecom there are some companies in that which are good quality companies, but the industry is stressed. And it may remain stressed for a year or two, but usually when the stress gets over, the quality companies start galloping.
Political pundits are of the view that this is the best we'll get when it comes to reforms, because SP and BSP, they both are unpredictable allies, and it's not going to be easy for government to kickstart another wave of reforms, which means this is the best, this is as good as it gets when it comes to news from New Delhi.
I think in a way, I think that there will be more, and we are calling them reforms, but I think these are not reforms, these are, I like to call them strong policy actions. So, because reforms...
They will not change your earnings. So what are markets excited about, apart from a gesture? The fact that we managed to, avert a downgrade, we managed to fix a rupee in the near term, that's about it. The end objective is to get growth back.
No, I think the diesel price increase is a very, very clear signal that we are going towards at least getting that, big stone off our back. And I think this diesel price increase will save the government 40 to 50,000 crores a year if they, if they keep this price. So I think on the whole, some kind of fiscal consolidation is coming in. So as I said, there was the last time when we spoke, the fiscal deficit was the only one where we were uncertain. Now the government's ability to sell shares, which I was expecting about 35,000 crores, they'll be able to do that. This will save another 40,000 crores. So on the whole, some fiscal consolidation improvement will come about. Current account is coming slightly, is improving. I think only when it comes under 2%, I'll feel it's under control. But at 3%, it's not as bad as 4%. So I think that is coming under control. Hopefully, interest rate cut will happen. So there is gradual improvement. It's not really the gaga days and very happy and everything is hunky-dory. But from where we were in 11, I think 12 will be a much happier place when we end the year.
So 2011, money was made by going short on Indian equities. Now it's time to go long on Indian equities.
I would say 2011, everybody was short on India. 2012, everybody long on India. Because it was not just equities. I think even interest rate cycle in 2011, interest rates were going up. So, being short India bonds, and some people would have made a lot of money. So I think on the whole, 2011 was a very bad year for India. First half of 2012, we have seen some gradual improvements. Second half is turning out to be, even better. It's still, you should go about it very slowly. The next 3-4 quarters are very important. And hopefully you will start seeing earnings growth. And my ideal is when your GDP growth rate is above your inflation rate, and that's the indicator I always look for. So currently we are still at GDP will be 6 and inflation will be 7. If inflation is at 6 and GDP growth rate is 7, then happy days are here again for India, and you should wait for that crossover to happen where your GDP growth rate is now going above the inflation rate.
Give me a money-making idea before we wrap. Right now we are talking about sectoral allocation, we are talking about asset allocation. A solid money-making idea from Rashesh Shah's mouth. Let's hear it from the horse's mouth. The terminology I use on air often.
I think we are fairly bullish on the rupee because we do think the rupee will also appreciate as with this global flows and improvement in India. I think rupee is a good idea. I think equity market is a good opportunity to be long on equities in India.
So you will not be surprised if we hit a new all-time high on the index in the next 6 months?
I think given the liquidity where we are going to surprise, I'm not expecting it because I think we need consolidation phase. So I'm not expecting it. I wouldn't be surprised because liquidity has its own way of actually pushing asset prices up. But I'm not actually expecting it. I think there is a consolidation that is required because otherwise the market will run ahead of itself. So, but I do think there is a gradual stability in the market. Optimism is coming back, and as I said, people are underweight India.
Out of the 4 businesses which you manage, one is prop, which is an insulated business. The 3 businesses, brokerage, NBFC, and the M&A business. Which business has revived and which business is still going through stress?
We actually have about 7 businesses now.
Is insurance also included now?
We have insurance, we have commodities, we have housing finance. So I think capital markets for the last, the entire brokerage, investment banking has been stable. It's improved in the last month and all, but it's been last 3 quarters has not got worse, did not improve. Until September it started improving a little bit. I think credit NBFC is doing well. I think there is a lot of demand for credit. There are good quality credit available. I think housing finance is doing well, and I think we are hoping housing will start picking up because house buying has slowed down in the last year. So I think, but housing is it's still growing at 18%, 20% a year, housing in India. So housing is a good industry. Commodity is doing very well because I think there is an entire financialization of commodities going on in India. I think insurance we just started. It's still early days. Insurance will still take another year and a half for the industry it's still in a restructuring phase, the whole industry.
There is a buzz that FDI in insurance could come. Will that help the industry? Because what my understanding is that none of the large 10-15 players, they actually need foreign capital.
No. I think FDI in the industry will help a lot. FDI will help. I think a lot of the larger companies will start investing again. I think what has happened in the last 3 years, given this situation and the change in the industry, a lot of people have been scaling back.
But do you need capital? You don't need capital.
No, capital is very important. Capital is important for people to start investing back in growth and all of that. So I think a large part of the industry will be very happy when capital comes in. It will be good for India because this is an industry that needs capital. The more you invest in capital, the more you can harness. See, think about insurance as harnessing savings into long-term investments. If insurance isn't able to do it, a lot of that goes into gold and real estate and all, which is what has been happening. So the insurance industry has to invest again into the business, and I think FDI will be a good spur for that.
I know the Mumbai Marathon is in December and we'll meet before that, but I hope you're preparing well for the Mumbai Marathon.
Yeah, it is going to be in Jan, so hopefully I think it will be a good time in Mumbai, not too hot, but it should be fun.
Good to have you on the show as always, and thank you for your insights. That's it on the show. Thank you for watching this edition of Market Makers. I'm Nikunj Dalmia signing off.